Most retirees assume property taxes are just part of owning a home, but there are tax forms sitting in county offices across America that can lower, freeze, or even eliminate part of that bill. And the surprising part is that many homeowners who legally qualify never file them. To understand why that matters, you first have to realize how much money property taxes can quietly cost over the course of retirement. Part 1. The bill that never goes away. Most people think the biggest housing expense disappears the day they pay off their mortgage, and in one sense that's true. The monthly payment you've been making for 20 or 30 years eventually comes to an end. But another bill keeps showing up year after year, long after the house is fully yours. Property taxes. In fact, for many retirees, property taxes become one of the largest recurring expenses they'll pay for the rest of their lives. The average homeowner in America pays somewhere around $4,800 a year, although in some parts of the country it's much higher. And here's what makes that number surprising. If you're 65 years old today and stay in the same home for another 20 years, that's nearly $100,000 in property taxes over the course of retirement. In some counties, the number can be significantly higher. Most people simply accept that as the cost of owning a home. They assume that if there were a way to lower that bill, somebody would have told them about it already. But that's not always how the system works, because there are tax forms sitting in county offices across the country that can lower, freeze, and in some cases dramatically reduce what retirees pay every year. The surprising part isn't that these programs exist. It's that many homeowners who qualify never even realize they're available. Part 2. Why nobody tells you about these forms. Most people assume that if a tax break exists, someone will tell them about it. Maybe the county sends you a letter when you turn 65. Maybe your mortgage company points it out. Maybe your accountant mentions it during tax season, but that's usually not how it works. In fact, many retirees spend years paying the full property tax bill simply because they assume that if they qualified for an exemption, it would have happened automatically. And that's where a lot of people get caught off guard. Because being legally entitled to a tax break and actually receiving it are two completely different things. The county doesn't call to remind you that you've reached a certain age. They don't automatically send you the paperwork on your 65th birthday. And in many cases, nobody sits down and explains which programs you may qualify for. As a result, two neighbors can live in nearly identical homes on the same street and end up paying very different property tax bills, simply because one of them filed the right form years ago. And here's what's surprising. For many retirees, it all starts with a single form that they assume has already been taken care of. In reality, thousands of homeowners discover that they never filed it at all, and without that form, some of the biggest property tax savings available to seniors may never become available in the first place. So let's start there. Part 3. The Gateway Form, Homestead Exemption. The form that opens the door to many of these tax breaks is called the homestead exemption. And here's the surprising part. A lot of homeowners are absolutely convinced they've already filed it. In many cases, they haven't. The exact rules vary depending on where you live, but the basic idea is simple. The county reduces the taxable value of your primary residence before calculating your property tax bill. In Florida, for example, homeowners can exempt up to $50,000 of their home's value. In Texas, that number can be even higher for certain parts of the tax bill. That means if your home is worth $300,000, the county may calculate your taxes as if it were worth much less. And over the course of retirement, that difference can add up to thousands of dollars. The problem is that many people assume this happens automatically. Sometimes it does, but often it doesn't. In many states, homeowners have to file a separate application with their county office, and there is usually a deadline. Miss that deadline, and you could end up paying the full tax bill for another year without even realizing it. That's why one of the most important questions you can ask is surprisingly simple. Is the homestead exemption currently on file for my property? Because for many retirees, this isn't just another tax form. It's the form that unlocks everything else. In fact, some of the biggest property tax savings available to seniors don't begin until after age 65, and without the homestead exemption already in place, you may not be able to claim them at all. But for many retirees, the biggest savings don't begin until age 65. Part 4. The Senior Exemption and the Tax Freeze. For many retirees, the real savings don't begin until age 65. That's because many states and counties offer additional programs specifically for older homeowners. Depending on where you live, these may be called senior exemptions, senior tax freezes, assessment caps, or something completely different. And while the names vary, the goal is often the same: to slow down, or in some cases stop, the growth of your property tax bill as you get older. To see why this matters, imagine two neighbors who both turned 65 this year. Each owns a home worth $250,000. Over the next 20 years, property values in their area rise steadily, and by the time they're 85, those homes are worth $500,000. One homeowner filed the proper paperwork with the county when he became eligible. The other assumed that if there were any special rules for seniors, somebody would tell him. 20 years later, they may be paying very different property tax bills, even though they live on the same street in nearly identical homes. In some areas, the homeowner who filed the right form could still be paying taxes based on a much lower assessed value. The homeowner who didn't file may be paying taxes on the full amount, and depending on the state, that difference can add up to $2,000, $3,000, or even $4,000 every single year. That's why retirees are often surprised to learn that property taxes aren't determined only by the value of your home. They're also determined by whether you know which programs exist and whether you've actually enrolled in them. Of course, the details vary enormously from one county to the next. Some areas freeze the taxable value of your home. Others reduce it by a fixed amount. Some have income limits, while others don't. But the important thing to understand is that turning 65 doesn't automatically activate any of these programs. In many places, you still have to ask, you still have to apply, and you still have to meet the deadline. But even these exemptions and freezes aren't the end of the story, because there's another property tax program that many retirees have never even heard the name of, and in some states, it can put money directly back into your pocket. Part 5. The hidden credit most people miss. Exemptions and tax freezes aren't the only programs worth knowing about. In some states, retirees may also qualify for something called a circuit breaker program. Most people have never heard the term before, but the idea behind it is actually pretty simple. These programs are designed to help homeowners whose property taxes become too large relative to their income. Depending on where you live, that help might come in the form of a tax credit, a rebate, or even a refund check sent directly to you. And one of the biggest misconceptions is that these programs are only for retirees with very low incomes. In reality, the rules vary dramatically from state to state. Some programs have fairly generous income limits, while others consider factors such as age, disability, or the value of your home. That's why two retirees with similar incomes, but living in different states, can end up with completely different outcomes. The challenge is that many homeowners never think to ask whether their state offers one of these credits in the first place. And because every state uses different names, different rules, and different deadlines, many people don't realize they were eligible until years later. Which brings us to the most important question of all. How do you actually find out whether any of these programs apply to you? Part 6. What to do tomorrow morning. By now you may be wondering whether any of these programs actually apply to you. The good news is that finding out is usually much easier than people expect. Tomorrow morning, pick up the phone and call your county tax office or visit its website, and start with just 4 questions. First, ask whether a homestead exemption is currently on file for your property. Second, ask whether your county offers any senior exemptions, tax freezes, or age-based reductions for homeowners over 65. Third, ask whether there are any state programs, such as credits or rebates, that you may qualify for. And finally, ask when the filing deadline is, because one of the biggest mistakes retirees make isn't failing to qualify for these programs. It's discovering them after the deadline has already passed. The reality is that every county has different rules, different forms, and different requirements, but a 5-minute conversation could potentially save you thousands of dollars over the years ahead. And that's exactly why these programs are worth knowing about in the first place. Property taxes may be one of the biggest expenses you'll pay in retirement, but as you've seen, there are programs that can lower that bill if you know they exist and file the right paperwork. Most people never ask the question, but a simple call to your county office could save you thousands of dollars over the years ahead. If you found this helpful, subscribe for more videos about retirement, taxes, and the rules most Americans don't discover until it's too late.